August 1st, some guy who works for the Fed who has a degree in BS economics. I know it's a BS in economics, but what's the difference really? He published an article on the Fed's website about the prospect of gold revaluation in previous gold revaluations that have happened and how they basically had no effect on anything important, except the three cases of gold revaluation that he cites are completely insignificant relative to the ones that he does not cite, and those are the one in 1933, which revalued gold 66% higher from 21 to 35, and the devaluation of the dollar in 1971 relative to gold when the final gold window was finally closed. But he doesn't mention either of these and their effect on inflation, or what he calls inflation, which is the rise in consumer prices. I will show you how gold revaluations severely affect price inflation as defined by the Keynesians with two simple charts, and gold revaluation, if and when it happens, is going to be at least 60 times worse because the revaluation will be a mark to market. And even assuming the market price remains at 3,400 whenever this passes, and it won't remain there, the effect of a gold revaluation on the dollar and prices will be extreme, and it will lead to the end game almost certainly. 1,295 grams per ton silver at the galleon target, 3.8 grams per ton gold at the horseshoe target. We've got copper, zinc, lead, antimony, gallium, indium, and tin. Rumor has it that Putin will be there soon, and he might take a look at the resources. I don't think he actually will, but it's an interesting coincidence. Now with that, let's go to the charts and an explanation why a gold revaluation would lead to a quick dollar devaluation from an Austrian School positivist logical perspective. For our first chart today, people have been asking me how long is this consolidation in gold going to last, and silver as well. Well, we're at nearly 4 months now, or a little bit past 4 months, about 4 months. We can see here that the candles are the price of the gold miners as represented by the GDX and GDXJ ETFs. We can see here they are both headed higher as of the beginning of August relative to gold, which remains in consolidation. The miners have broken out. When the miners tend to lead gold, that means that gold usually is at the end of its consolidation. Miners usually lead gold in their move. If miners are headed down and gold is not yet, that usually means that gold is headed for a dip. If miners are headed up and gold is not yet, that usually means that miners are leading gold higher. This consolidation is about to end. In my humble estimation, that is. You can see here that miners are up about 25% for the month of August, and gold has been relatively static. Where are we in terms of how nervous the Treasury is getting before there is something bad that happens in the monetary system? Well, it looks like Scott Bessent, our favorite Treasury Secretary, is getting pretty desperate because he's begging the Fed to cut rates 150 basis points. From Bloomberg, U.S. Treasury Secretary Scott Bessent made his most explicit call yet for the Federal Reserve to execute a cycle of interest rate cuts, suggesting the central bank's benchmark ought to be at least 1.5 percentage points, that is 150 basis points, lower than it is now. I think we could go into a series of rate cuts here, starting with the 50 basis point cut in September. That's what he wants. Bessent said in a television interview on Wednesday, if you look at any model, well, those models got to be hot. It suggests that we should probably be 150, 175 basis points lower. I wonder what model he's looking at. I noticed on Gold Charts R Us. This is a great site that I have a subscription to, and I recommend if you really follow the gold markets, it is very helpful. I looked at the gold future spread because I noticed that there was a record low spread between the 2-month and spot rate, which we'll get to in the next chart, how much it costs to lease gold for 2 months. It costs here 3.18%, which is an all-time record high. This was about 2 days ago. And so this is one indicator of gold backwardation. I don't think it's going to stick yet, but if gold is flirting with backwardation because gold now is worth more than gold in the future, which is a backward-dated state. And another word for endgame is permanent gold backwardation. We will get there.
You know, sometimes I read what the Fed publishes, and I wonder if they think we're all just fools. On August 1st, a Fed staffer with what he proudly calls a BS in economics, yes, I know it technically stands for Bachelor of Science, but let's be honest, most of us think the BS means exactly what it sounds like, published an article about gold revaluation. He managed to write several pages on the subject while skipping over the two most important revaluations of the last century, Roosevelt in 1933 and Nixon in 1971. Instead, he chose to cite three completely irrelevant examples that had basically no impact. You could almost hear the Fed whispering through the text, "Nothing to see here, move along, gold doesn't matter." Except it does matter. It has always mattered. And if history is any guide, the next time gold is revalued, the effect on prices, on the dollar, on everything you buy and sell will be catastrophic for the fiat system and liberating for those holding physical metal. Because what the Fed's BS economists conveniently forgot to mention is that in 1933, FDR devalued the dollar by 40%, raising gold from $20.67 to $35. That was a 69% jump in the price of gold overnight. And then in 1971, Nixon slammed the window shut, defaulting on gold convertibility and sending the dollar into free fall. Those weren't side notes. Those were epical events that redefined global finance. So when this Fed writer suggests revaluation has no effect, I can only laugh. It's like saying water doesn't make you wet. If Roosevelt's 69% revaluation led to a decade of rising consumer prices, and Nixon's default unleashed the inflationary 1970s, then what happens when gold is revalued today? Not by 69%, but potentially by 6,000% or more? Because that's what a true mark-to-market revaluation would look like. Let's run some math. The Treasury still officially values its gold at $42.22 an ounce, a number frozen in time since 1973. If you revalue that gold at today's market price, around $3,400, that's already an 80 times adjustment, and that's before any crisis premium. If, as James Rickards and others have argued, gold needs to be priced at $20,000 to $30,000 to balance the system, we're talking about a revaluation of nearly 600 times. The Fed may want to pretend that won't matter, but reality says otherwise. Now let's bring in the miners, because while gold itself has been consolidating, drifting sideways for about 4 months now, the miners are already sniffing what's coming. Look at GDX and GDXJ. Since early August, they've surged nearly 25%, even while gold has barely budged. That's not a random coincidence. Miners always lead. When miners rise while gold stalls, it means gold is about to break out. It's the canary in the coal mine, and the canary is singing loud right now. This is what consolidation looks like. Long, boring, sideways movement that makes you question why you even own gold. People get lulled to sleep. They sell. They chase tech stocks. And then, out of nowhere, the breakout comes. And by the time you realize it, you've missed the first 20% of the move. Meanwhile, in Washington, the Treasury Secretary, let's call him Scott Bessent, though honestly he sounds more like a desperate car salesman than a sober steward of the public purse, is practically begging the Fed for massive rate cuts. Not 25 basis points, not even 50, but 150 to 175. Think about how absurd that is. Just a year ago, the Fed was still pretending it could hold rates higher for longer. And now the Treasury is crying uncle saying, cut rates or the system breaks. What does that tell you? It tells you that the bond market is cracking. It tells you that the cost of servicing $34 trillion in federal debt is unbearable. It tells you that the Treasury knows the only way out is to debase the currency faster. And here's the kicker, the gold lease rate. If you've never looked at this, pay attention because it's one of the most important signals in the entire system. The gold lease rate is essentially what it costs to borrow gold for a short period. In early August, the 2-month lease rate hit 3.18%. That is an all-time record high. It means that the cost of getting your hands on gold for just 2 months is higher than ever.
We know that communist societies collapse. That's a given. I think we can all agree on that. Eventually they do, because if everyone steals from everyone, then nobody produces anything, which is exactly what happens in hard communism. And then everything falls over. Some people starve. Lots of people survive, and then they rebuild. We saw that happen with the Soviet Union. We saw it happen in China, which, they're still communist in name, but they've got free market zones, to survive. But if inflation itself is theft, which it is, then it's a theft of every transaction everywhere, but it clips a little off the top of every single transaction. So it's It's much slower also because as you produce more, as your society becomes more productive, the theft becomes more and more subtle. But still, even if it does, eventually a society built on theft will collapse. We just don't know exactly when, but it's the same principle because all societies based on theft collapse. Right? If you have a society that has theft in it, you can survive that by creating a justice system, creating a penal system to isolate the theft and put it away. But if everybody has to operate on theft because the entire monetary system where everyone's trading money is itself based on theft, then there's no way to escape it except getting out and getting gold and silver, getting real money. If we go back again to the Great Depression, what did the academics who were trying to solve this issue, what do they think was the problem? That prices aren't high enough. So if we can get the price level back to where it was in 1929 before the crash, then the crash will end. But really, the price level is just an effect of a much deeper problem down below. Why did prices fall? Because the inflation of the money supply was too high, and then it stopped. And then all these other industries that had overinvested in themselves, they collapsed.
Doesn't that sound like where we are right now, though?
Yeah, it is. So Trump is trying to say, well, we've lost manufacturing. So if we can just get manufacturing back, then we'll be back where we were in the 40s and 50s when we were, a powerhouse. But that's the same. It's the same pseudo logic as saying, well, in the 1930s, well, if we could just get the price level back to where it was in the 1929 before the crash, then everything will be fine. I don't think bringing manufacturing back should be a goal in itself. I think that manufacturing returning to the United States is a symbol. It's an outgrowth of the monetary system becoming honest once again. What does inflation do? It centralizes things to the cheapest countries, where workers have a lot fewer legislatively induced rights. There's child labor, and so things are going to go there where it's cheaper. That's just what's going to happen. I'm not against your plan, but what I would say is that, and I'll add another Torah-based story to this. That if we focus on just making money honest again, then all these things will happen. Manufacturing will return. And instead of having to legislate a universal basic income, we'll have the gold and silver supplies spreading out through an honest derivative system, and then people will become richer slowly but surely. I mean, we're not going to stop the crash. We're not going to stop people from falling. But what we can do is get out of the way, and then let the market function as it would function. So the story I can tell you, and I released this in a video recently to my Patreon subscribers, is that I came across a verse that said that the menorah, the golden menorah, this big block of gold, right? And God tells Moses how to make the menorah. So the verse says that the menorah was made. It doesn't say that Moses made the menorah. So the rabbis pick up on this statement. They're like, what do you mean the menorah was made? Didn't Moses make it? And then they say, no, actually he didn't. He didn't know how. He was trying to, and he kept failing. And so Moses says to God, I'm just going to put this block of gold in the fire, and you, God, you can make it into a menorah however you want, because I can't do this. It's too hard for me. So, I mean, what does that tell me? It tells me that if we just return to honest money, return to honest gold, honest silver, there's going to be consequences. People are going to fall, but it's going to be up to stackers and other people that have real assets and gold to help rebuild and find the talent, find people who can do things with our money and become the capitalists of the world. And then these problems will work themselves out. I don't think it's up to us to discover a grand system or a grand solution to all this, where and put this variable here and that variable there. And if we just make this trampoline or this what do you call it? That the stunt people they fall on when they're falling from the sky, like a big pillow.
Yeah, I know what you mean.
Yeah, whatever it is, it might be a good idea. But I don't have the expertise to tell you that. I just know that we have to go back to honest. It's not exactly bad money drives out good. And Rothbard made this distinction. He's like, this is not a good definition. It's not bad and good. It's artificially overvalued money drives out artificially undervalued money, right? The dollar, the paper dollar, or the digital dollar, or the stable coin backed dollar, whatever form the dollar is, it's worth intrinsically nothing. The gold is the good money, and it's undervalued because if it were backed 1-to-1 with every dollar, it would be something like $40,000, $50,000, and it's only valued at $3,400. So it's artificially undervalued. Once gold is valued as at par with the dollar, whatever that is, either we get there legislatively and they say, oh, we're on a gold standard now at this exchange rate, I don't think that's going to happen. Or the market forces it like it did in 1980. And what happened in 1980, the way Daniel Oliver of Myrmikan Capital puts it, is that if you look at the Fed's balance sheet, the valuation of the gold on their balance sheet, more than 100% balanced all the other assets, all the debt, all the treasuries, and all the other crap they had. The amount of gold in 1980 valued at 850 backed every other liability by 100%. That functionally is a gold standard.
We left off with the fuse burning, miners leading, lease rates spiking, backwardation looming, in the treasury begging for cuts like a desperate gambler at the blackjack table asking the dealer for just one more card. Now let's talk about silver, because if gold is the fire alarm, silver is the explosion that follows. Historically, gold and silver have maintained a ratio of about 15 to 1. For every ounce of gold, there were roughly 15 ounces of silver. That's not some arbitrary number. It's what the Earth gives us. Geologically, silver occurs about 15 times more abundantly than gold. That's why ancient civilizations adopted that ratio. It wasn't theoretical, it was natural law. Fast forward to today. The gold to silver ratio isn't 15. It isn't even 50. It's been hovering in the 80s, sometimes even over 90. That's not natural. That's distortion. And distortions don't last forever. When this one snaps back, and it will be violent. If gold goes to $10,000 and silver returns to 15 to 1, you're talking about silver at $666. And that's not some pie-in-the-sky fantasy. That's just math. Now think about what happens in a credit collapse. When the dollar falls, when credit evaporates, all that purchasing power doesn't disappear. It shifts. It has to find a home. And historically, that home is precious metals. Gold for the central banks, the sovereigns, the ultra-wealthy. Silver for everyone else. Silver is the money of the people. It always has been. When Rome debased its currency, silver was the first to go. When the U.S. committed the crime of 73 and demonetized silver, it was the middle class and the poor who lost their store of value. And when silver reasserts itself in the next collapse, it won't be because some think tank says so. It'll be because ordinary people need money that works. That's why I say the true endgame is a silver standard, not a gold standard. Gold will play its role, yes, but silver is the bedrock of daily commerce. It's the coin of the realm. And in a collapse, when trust is gone, silver's utility will outshine even gold. But let's step back for a second, because the collapse of credit isn't just about math, it's about morality. Inflation itself is theft. Every new dollar printed steals a fraction of every transaction. It's the most insidious tax because it hides in plain sight. You work, you save, you produce. And silently, invisibly, your purchasing power is clipped. That's why societies built on inflation always collapse. Communism collapses because everyone steals outright. Inflationary fiat collapses because everyone steals subtly. But in both cases, theft erodes the foundation until there's nothing left. And that's where we are. We're not just in an economic cycle, we're in a moral reckoning. Fiat money is theft, and theft must be paid for, either by default or by collapse. There is no third option. Now some will say, but Rafi, won't bringing back manufacturing fix it? Won't reshoring supply chains save us? That's like saying in 1930, if only we can get prices back to 1929 levels, the depression will end. It misses the point. Manufacturing doesn't disappear because of bad policy alone. It disappears because inflation distorts incentives, sending production to the cheapest labor markets, centralizing power where rights are weakest. Bring back honest money and manufacturing will return naturally. Without honest money, no amount of policy tinkering will matter. And this is where I want to tell you a story. In the Torah, when God commanded Moses to make the golden menorah for the tabernacle, the verse doesn't say Moses made it, it says the menorah was made. Why? Because Moses tried and failed. He couldn't do it. Finally, he threw the gold into the fire and said, God, you make it. And out came the menorah. Perfect. The lesson is simple. Some things are beyond human engineering. You can't design your way out of a broken monetary system with clever policies or fancy derivatives. You have to throw the gold into the fire. You have to let the system burn down, and from the flames, honest money will emerge. Painful? Yes. Necessary? Absolutely. That's why I keep telling people, don't wait for the government to legislate a gold standard. They won't. Don't wait for some grand plan. It won't come. The market will do it. Just like in 1980 when gold at $850 backed every liability on the Fed's balance sheet 100%. That wasn't legislation. That was reality. That was the market saying, you're done. Now imagine that again, but bigger. Imagine a Fed balance sheet bloated to $9 trillion, a treasury debt at $34 trillion, and gold suddenly repricing to cover it all. That's not fantasy. That's inevitability. Whether it happens at $20,000 or $30,000 gold, whether silver is $500 or $1,000, the math is the math. And math doesn't negotiate. Let's not forget geopolitics. BRICS nations are already preparing for a post-dollar world. Russia and China are hoarding gold like there's no tomorrow. Central banks bought a record 1,082 tons of gold in 2022. Why? Because they see what's coming. They know the dollar is dying, they know the West is bankrupt, and they're positioning for the reset. Meanwhile, here in the West, what are we doing? We're publishing BS articles pretending gold revaluation doesn't matter. We're begging for rate cuts. We're lying about inflation. And we're hoping nobody notices the cracks. Spoiler alert, the world notices. Even US states are rebelling. Florida, Texas, Utah. They're passing laws recognizing gold and silver as legal tender. Some are even setting up depositories where citizens can pay taxes in gold. That's not symbolic. That's a declaration of independence from the Federal Reserve. It's a miniature secession in monetary form. And as the crisis deepens, more states will follow. This is why I say the endgame won't be orderly. It won't be some neat, polite transition. It will be chaotic. Some states will cling to the dollar. Others will move to gold and silver. Some nations will adopt commodity-backed currencies. Others will collapse outright. And through it all, those holding physical metal will be the ones with power. Now let me bring in another signal. Premiums. Right now, in many parts of the world, physical gold and silver trade at significant premiums over paper. That tells you everything you need to know. The paper price is fake. The physical market is real. And as more people demand delivery, the paper illusion will shatter. Think back to March 2020. In the panic, silver supply dried up. Premiums soared to 100% over spot. Dealers were charging $30 when spot was $15. That was just a taste. Imagine that on a global scale. Imagine a world where spot says $100, but you can't find a coin under $200. That's where we're headed. And here's the irony. The Fed thinks it can control this with models. The Treasury thinks it can finesse it with rate cuts. Wall Street thinks it can arbitrage it with futures. But none of them can print silver. None of them can conjure gold. Reality always wins. Let me end with this. We live in an illusion. Prices aren't rising. The dollar is falling. Goods priced in gold have been falling for decades. But if you measure your life in fiat, you live in the illusion. If you stack gold and silver, you step out of it. You may still need to transact in dollars, but your wealth is preserved outside the matrix. That's the goal. The end game is not about getting rich. It's about surviving the collapse of theft. It's about rebuilding on a foundation of honesty. Gold and silver aren't just metals. They're morality in physical form. They're contracts that can't be broken. And when the fiat illusion dies, they will be the seed of renewal. So stack now, because when the menorah emerges from the fire this time, you'll want to be one of the people holding the gold.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.